What is happening, crypto fam? Welcome back to Bitcoin Bulletin, your number one source for the absolute latest and most explosive news in the digital asset space. The market is moving at lightning speed, and if you're not plugged in, you're missing out on the biggest shifts. We've got a packed show today that you absolutely cannot afford to miss. Get ready, because we're diving headfirst into the stories that are defining the future of finance. Let's get this party started. First up, we're talking about a seismic shift in institutional crypto portfolios. Forget what you thought you knew about where the big money is flowing, because the data is in, and it's telling a story of a dramatic reallocation. Think Ethereum is just the underdog. Think again. We're breaking down exactly why this digital asset is starting to eclipse even Bitcoin in the eyes of major players in the third quarter of 2025. You won't believe the numbers. Then, we're shifting gears to the massive world of Bitcoin ETFs. These products have been a game changer, accumulating an astonishing amount of Bitcoin, but is the party winding down? We're seeing some serious shifts in market preferences, with institutions apparently looking elsewhere. We'll explore what this means for the future of digital asset allocation and the evolving narrative around these powerful investment vehicles. Next, we're diving into the fascinating relationship between gold's record-breaking run and Bitcoin's potential next move. Is the yellow metal a bullish signal for crypto, or does its strength highlight Bitcoin's own vulnerabilities as a safe haven asset? We'll unpack the competing theories and look at the macro factors driving both markets and what it means for your portfolio. And finally, hold onto your hats, because a major player has just made a massive acquisition, snapping up thousands of Bitcoins in a multi-million-dollar deal. We're talking about a significant strategic move that could have ripple effects across the entire market. What does this massive buy signal for the future? We've got all the details. Don't go anywhere. Hit that like button, subscribe to the channel, and ring that notification bell so you never miss an update. Let's go. Ethereum is eating Bitcoin's lunch, the institutional pivot revealed. The cryptocurrency landscape is in constant flux, and a major reevaluation of institutional investment strategies is currently underway, signaling a potential paradigm shift in digital asset allocation. While Bitcoin has long been the undisputed king, recent trends suggest that Ethereum is rapidly gaining ground, even eclipsing Bitcoin in the eyes of major institutional players for the third quarter of 2025. This development is not just a minor blip. It represents a significant reshaping of how large investors are viewing and allocating capital within the crypto space. The data emerging from the market paints a clear picture of this evolving sentiment. Bitcoin exchange-traded products, ETPs, which have been instrumental in bringing substantial institutional capital into the cryptocurrency ecosystem, currently hold an impressive 1.47 million Bitcoins, representing a significant 7% of Bitcoin's total capped supply. The majority of these holdings are concentrated in US-based funds, with 11 ETFs alone accounting for over 1.29 million Bitcoins. BlackRock's iShares Bitcoin Trust, ETF, leads this charge, holding a staggering 746,810 BTC, followed by Fidelity's Wise Origin Bitcoin Fund, with approximately 199,500 BTC. This substantial accumulation underscores the enduring confidence many institutional investors, often referred to as crypto whales, have had in Bitcoin as a primary digital asset. However, a closer examination reveals a less optimistic outlook for Bitcoin's demand in the immediate term. August witnessed a net outflow of $301 million from Bitcoin ETPs, a clear indicator of waning institutional enthusiasm. This outflow coincides with a discernible migration of significant capital towards Ethereum. Blockchain analytics firm Arkham has reported that 9 key whales have collectively divested approximately $456 million from Bitcoin specifically to invest in Ether. A particularly striking example involved a prominent Bitcoin whale liquidating 4,000 BTC to acquire 96,859 Ether, a transaction valued at roughly $3.8 billion. These moves suggest a strategic pivot, with institutions increasingly viewing Ethereum as a more compelling investment opportunity. The broader market context further amplifies this trend. With nearly 92 crypto-based ETFs awaiting potential approval from the Securities and Exchange Commission, SEC, the market is abuzz with anticipation. Investors are keenly watching for developments around ETFs focused on assets like Solana and XRP, with significant announcements expected in October that could dramatically alter market dynamics. Should Ethereum-related ETFs receive the green light, it would undoubtedly provide a substantial boost to Ether's investment appeal, potentially accelerating its adoption by institutional investors. This shift necessitates a reevaluation of traditional investment strategies. Where Bitcoin was once the sole focus for institutional investors seeking long-term growth, there is now a growing emphasis on diversification, with Ethereum and other altcoins increasingly being incorporated into portfolios. This evolving approach highlights the need for innovative investment methodologies that can effectively navigate the expanding universe of digital currencies. The divergence in demand between Bitcoin and Ethereum is becoming increasingly evident, forcing investors to carefully consider their allocation strategies. The path forward for Bitcoin's mainstream acceptance remains intertwined with institutional sentiment and regulatory developments. The coming months, especially with crucial SEC rulings on new ETFs on the horizon, will be pivotal in determining the future trajectory of these leading digital assets. But is this just a temporary dip or the start of a major rotation? Stay tuned as we analyze the impact of these shifts on the broader crypto market. Bitcoin ETFs, a flood of capital, but is the tide turning? The cryptocurrency market is a dynamic ecosystem, constantly reshaped by evolving investor preferences and the introduction of innovative financial products. Among these, Bitcoin exchange-traded products, ETPs, have played a pivotal role, attracting substantial institutional capital and solidifying Bitcoin's position in the mainstream financial world. These ETPs have managed to accumulate an impressive hoard of over 1.47 million Bitcoins, a figure that underscores the significant institutional confidence in the digital asset. However, beneath this impressive accumulation, a subtle yet significant shift in market sentiment appears to be underway, with early signs suggesting a potential waning of enthusiasm for Bitcoin as the primary institutional darling. Currently, Bitcoin ETPs hold a formidable 7% of Bitcoin's total capped supply, with the lion's share of this accumulation, over 1.29 million Bitcoins, residing within 11 US-based ETFs. Leading the pack is BlackRock's iShares Bitcoin Trust ETF, which has amassed approximately 746,810 BTC. Following in its wake is Fidelity's Wise Origin Bitcoin Fund, holding around 199,500 BTC. These substantial holdings are a testament to the sustained bullish conviction held by institutional investors, often dubbed crypto whales, who have historically viewed Bitcoin as a cornerstone of their digital asset portfolios. This influx of capital has been a major driver of Bitcoin's price appreciation and market integration. Yet the narrative is beginning to change. The month of August saw a net outflow of $301 million from Bitcoin ETPs, a stark indicator that demand is cooling. This outflow signals a notable pivot in institutional sentiment, prompting questions about the future allocation of digital assets. As investment strategies undergo a significant rebranding, Ethereum is emerging as a compelling alternative, beginning to eclipse Bitcoin's former dominance in the eyes of some major players. This pivot implies a potential reevaluation of the overall investment narrative surrounding digital assets. This trend is further exemplified by the recent actions of significant market participants. Blockchain analytics firm Arkham has revealed that 9 key whales have collectively liquidated approximately $456 million from Bitcoin holdings, redirecting these funds into Ether. One particularly notable instance involved a prominent Bitcoin whale exchanging 4,000 BTC for 96,859 Ether, a transaction valued at approximately $3.8 billion. Such large-scale movements indicate a broader strategic shift, where capital is being reallocated from Bitcoin to Ethereum, suggesting a growing belief in Ether's potential for future growth and adoption. Adding to the market's dynamism nearly 92 crypto-based ETFs are awaiting approval from the SEC. Investor focus is particularly sharp on funds centered around assets like Solana and XRP, with potentially market-altering announcements anticipated in October. The anticipation surrounding these potential approvals creates an environment of speculation and potential volatility as investors position themselves ahead of regulatory outcomes. Should Ethereum-related ETFs gain approval, it could significantly enhance Ether's investment allure and further accelerate its integration into institutional portfolios. In essence, the cryptocurrency world is at a crossroads. While Bitcoin ETPs have been a powerful force in institutional adoption, the recent outflows and the burgeoning interest in Ethereum suggest a need for a more diversified approach to digital asset allocation. Investors must remain vigilant, adapting their strategies to the rapidly changing market dynamics and the implications of upcoming regulatory decisions. The interplay between Bitcoin ETFs, Ethereum's ascent, and the potential approval of new crypto ETFs will undoubtedly shape the next chapter of this evolving financial ecosystem. So, is this the beginning of a new digital asset hierarchy, or just a temporary market correction? We'll break down the implications for your investments next. Gold's rally ignites Bitcoin debate, safe haven showdown. Gold has achieved a remarkable feat, surging to new all-time highs and simultaneously reigniting a long-standing debate about its relationship with Bitcoin. This impressive performance by the traditional safe haven asset has created a clear divergence in market analysis, with some experts viewing gold's strength as a bullish indicator for cryptocurrencies, while others contend it highlights Bitcoin's inherent fragility when compared to established stores of value. From the perspective of macro traders, gold's current breakout is interpreted as a key indicator within a broader global liquidity cycle. Analysts, such as Marta Party, have observed a pattern where gold often leads the charge during periods of expanding global liquidity, with Bitcoin typically following suit after an initial phase of market volatility. This historical correlation was evident earlier in the year when gold approached the $3,500 mark. Bitcoin experienced a brief pullback before staging a significant rebound to new highs. Bulls are now anticipating a repetition of this pattern, expecting Bitcoin to follow gold's upward trajectory. Conversely, skeptics offer a more competitive interpretation of the dynamic between gold and Bitcoin. Prominent crypto critic Peter Schiff, for instance, points to gold's ascent beyond $3,480 and silver's V1B0 qua $40 as evidence that investor capital is being diverted from digital assets into precious metals. Schiff argues that as Bitcoin slips below the $108,000 threshold, this divergence between the two assets, perceived as hedges against inflation and uncertainty, is likely to widen. This perspective suggests that in times of economic uncertainty, investors gravitate towards traditional, tangible assets over more speculative digital ones. The macroeconomic backdrop fueling gold's upward momentum is characterized by expanding liquidity and pervasive uncertainty. Analysts estimate that global liquidity saw an increase of over $130 billion in a single week, an influx that has invigorated risk assets across various markets. This liquidity expansion is coupled with persistent inflationary pressures, growing skepticism regarding the Federal Reserve's independence, and a steady climb in long-dated bond yields. These factors collectively reinforce gold's traditional role as the ultimate safe haven asset. For many institutional investors, this confluence of factors has reaffirmed gold's status as a reliable store of value, even as Bitcoin continues to cultivate its reputation as digital gold. This split in opinion underscores the ongoing tension between the established world of traditional hedges and the emerging narrative of decentralized digital assets. The critical question remains whether Bitcoin will follow historical cycles and mirror gold's upward movement, or if the rotation of capital into metals will continue to exert downward pressure on the crypto market. For proponents of Bitcoin, the expansion of liquidity is the crucial element that could reignite risk-taking across digital assets. However, for detractors, Bitcoin's recent price action below key levels suggests that traders still default to traditional stores of value when uncertainty peaks. As both gold and Bitcoin venture into uncharted price territories, the debate over their respective roles as safe haven assets is far from settled. The outcome of this narrative clash, whether Bitcoin joins gold in setting new records or continues to lag, could significantly define the future of the safe haven debate in the digital age. Will Bitcoin follow gold's lead, or is this a sign of shifting investor priorities? We'll explore the implications for the crypto market right after this. Strategic bull run. Major player amasses thousands of Bitcoins. A significant strategic acquisition has just sent ripples through the cryptocurrency market, with a major player reportedly acquiring a substantial amount of Bitcoin in a multi-million-dollar deal. This move signals a strong conviction in the digital asset's future and could have considerable implications for market dynamics and investor sentiment. The sheer volume of the purchase underscores a bullish outlook from a key market participant, potentially influencing the trajectory of Bitcoin's price and adoption. While the specific identity of the acquiring entity remains under wraps for now, reports indicate the purchase involved 4,048 Bitcoins, valued at approximately $449.3 million. Such a large-scale acquisition is not merely a routine investment. It represents a deliberate strategy to increase holdings in Bitcoin at a time when the market is experiencing significant shifts and anticipating future growth. This type of accumulation by institutional or significant private entities often serves as a powerful signal to the broader market, bolstering confidence and potentially attracting further investment. The timing of this acquisition is particularly noteworthy. It comes amidst a period of intense activity in the crypto space, including discussions around new ETF approvals, evolving regulatory landscapes, and the ongoing debate about Bitcoin's role as a digital store of value, often compared to gold. The fact that a major player is making such a substantial commitment to Bitcoin suggests a belief in its long-term potential, possibly outweighing short-term market volatility or concerns about competing assets. This strategic accumulation could be interpreted in several ways. Firstly, it might indicate that the acquiring entity views Bitcoin as undervalued at current price levels, anticipating significant appreciation in the near future. Secondly, it could be part of a broader diversification strategy, where large holders are increasing their exposure to digital assets as a hedge against traditional market risks, or as a way to capitalize on the growth of the digital economy. The sheer size of the purchase also means it could have a noticeable impact on Bitcoin's supply and demand dynamics, potentially supporting its price. Moreover, such a significant acquisition by a major player often triggers increased interest from other investors, including retail participants. When large, influential entities make substantial moves, it can create a positive feedback loop, attracting more capital into the market. This can lead to heightened trading volumes and increased price discovery, ultimately contributing to Bitcoin's overall market maturation. The market will undoubtedly be watching closely to see if this acquisition spurs further institutional interest and if other major players follow suit. Understanding the motivations behind such a substantial purchase is key to deciphering its potential impact. Whether it's a direct response to market signals, a long-term strategic play, or a combination of factors, this acquisition is a clear testament to the growing role of significant capital in the cryptocurrency market. It reinforces the narrative of Bitcoin's increasing integration into the global financial system and highlights the ongoing battle for dominance among various asset classes. This massive buy is a clear signal, but what does it mean for the rest of the market? We'll break down the potential impact on your crypto portfolio next. And that's a wrap on today's massive crypto news. We saw Ethereum starting to outshine Bitcoin in institutional portfolios, Bitcoin ETFs facing potential shifts in market preference, gold's record runs sparking debate about Bitcoin's safe haven status, and a major player making a huge Bitcoin acquisition. What a day for crypto. Don't forget to smash that like button, subscribe to Bitcoin Bulletin for all your essential crypto updates, ring that notification bell so you never miss a beat, and let us know your thoughts in the comments below. Follow us on all social media platforms to stay connected. We'll see you in the next one.